Thanks for joining us on Trading Day. We have lots coming up on the show today. And I'm Roger Peterson. We'll get to some of our interviews in just a second. But first up, the stories we're following in the BNN Bloomberg newsroom. Prime Minister Mark Carney has landed in Australia after wrapping up his trade trip to India. Carney is expected to meet business leaders in Sydney as Canada seeks to build on strong intelligence ties by broadening collaboration in defence and trade. Carney will also meet with Australian Prime Minister Anthony Albanese and address the Australian Parliament before leaving for Tokyo. Shares of Pet Value are plunging today, off by nearly 13%. The pet food and supply retailer reported adjusted profit for its latest quarter that missed estimates and also posted revenue that came in below expectations. Pet Value's earnings and same-store sales also fell short of what analysts were expecting. One bright spot, the company boosted its dividend by 8%. Shares of Roots are trading higher. That's after the Canadian clothing retailer said it's exploring a strategic review that may lead to a sale of the company. Roots says the move is to analyze options in order to boost value for shareholders. Roots opened its first location in Toronto in 1973 and has more than 200 stores across Canada and Asia now. All right, let's take a look at the markets and see how they are doing right now. They're calming down a little bit. They're still in the red, but not as bad as what they were. The TSX at one point was off 3.4%. It's now down by 2.3. Most sectors are in the red right now, but there are a few energy groups that are doing all right. South of the border, not much better, not much different. Everybody reacting to what is unfolding in Iran and what Donald Trump said, and that is fueling the markets down. But you can see even they have kind of recovered to a degree. The S&P 500 up by 1.17, the Dow by 1, and the Nasdaq by 1.3. And of course, it's everything that is unfolding in Iran that is having an impact on the global markets, including the TSX. At one point, it was mentioned, as we mentioned, was up by almost 1,300 points. Our next guest says conflicts, though, tend to resolve or fade in market relevance over the intermediate term. Here to discuss today's markets, Brad Long, CIO of WealthSpire. Brad, thanks very much for joining us.
Yeah, my pleasure.
It's been an interesting couple of days. I mean, yesterday everybody seemed to think the world was okay, even though what was unfolding in Iran. And then with comments made by Trump, we saw that everything's not okay today. Where do you think we're heading, though? There's a lot of unknowns still.
Yeah, it's all about the timing and escalation here. You know, when we came into this conflict, and we've had a few dust ups as of late, right, through Latin America and others, it could have been a 1 day, 2 day type skirmish. Obviously, over the weekend, that began evolving and into the week. As escalation continues, I think that's where the market really starts to get shaky. If you see, obviously, expanded options in the Straits of Hormuz, what's going to happen with global oil supply and, moving into the rest of the Middle East, that's where the market obviously caught back up today and said, hey, we're a little bit nervous about where this is going and what it's going to do to geopolitical risks, what it's going to do to economic risks, and what it's going to do potentially to inflation, both here and globally.
Yeah, I think when we saw attacks, we have Qatar, their natural gas is shut down right now. Saudi Arabia getting hit, looking at alternate directions that they can move their oil. That really drove it home. I mean, the Strait of Hormuz, takes 20% of the world's oil, and Qatar is responsible, I think, for about 20% of the natural gas. So that is a lot. And how long before we would start to see some major impacts on, say, North America with delays of that oil getting through that area?
North America, there's definitely influence here, and it's not just oil, right? You have aluminum. This, a major supplier outside of China is in the Middle East, but oil is perhaps the most headline and acute issue here. Now, if you think about the majority of the oil, about 85% of the oil that goes through the Straits of Hormuz is actually on its way to Asia. China, Japan, and other countries far more influenced by the cutoff of that flow of goods. The U.S. is a net exporter of oil. It doesn't mean that we won't be influenced by this event. It doesn't mean prices may rise, and obviously that's at somewhat conflict of what the U.S. administration is seeking to do around affordability in the midterm elections here. It might put a kind of kink in the armor, if you will, of Kevin Warsh's intent to potentially move interest rates lower. So the acute impact, I think, is really going to be felt in the East, but the U.S. won't be left alone.
And then, of course, you're talking about the markets. I mean, we're seeing the TSX at one point was down 1,300. They do have a tendency to recover from these events fairly quickly. But how long can this go before it becomes bigger than that?
Yeah, I mean, if we look back over, call it the 19th century, right? When we get events like this, their average duration is only 15 days. I think the unfortunate thing about geopolitical events is that from a humanitarian perspective, obviously they're very important and they're very important to resolve in the short term. From an economic perspective, they don't tend to be all that meaningful. They tend to be more emotionally led. Even if we think about the production of global GDP out of the Middle East, not just Iran, but really the entire affected region, it's less than 2.5% of global GDP production. And so, these events, they, from a market perspective, tend to be short-lived. Obviously, from a humanitarian perspective, it's very different. And we don't really have a reason to believe that this would be unique here. We'll probably see intermittent volatility. We'll especially see it on the energy side. Obviously, we're seeing it in Brent across the pond here and even in WTI in the US. But we don't really anticipate a whole lot of flow through that will continue over the coming days.
Could we see an inflation impact with this that could linger?
Headline inflation certainly could be influenced. Obviously, the US Fed is far more focused on core inflation, or PCE is their preferred individual metric. So the influence of that and Fed policy is probably not as important. But when it comes back to, the American election cycle and obviously the midterms coming up, the big key theme is around affordability. That's what the Democrats and Republicans are running on. When gasoline is higher at the pumps, especially, if this continues on and into the summer, those things ultimately influence outcomes and influence votes. So we don't think it would structurally move inflation in a meaningful way, or at least it would impact policy, but we can see it having an impact perhaps on the political side of the spectrum.
So this really, it sounds like to a degree, a time just to pause and breathe for a second. And then are you looking for opportunities with everything that's unfolding?
When we find moments like this, especially that they're, not existential, they're external events, right? We can't control them, nor can we necessarily predict them. The market tends to be emotional. In those moments, I think your first comment is exactly right. We need to pause, collect, and make sure that our portfolio is still positioned well. Now, as we look forward, we still think some of the big opportunities that we saw coming into the year still persist. There's a lot of opportunity, we think, still outside of the United States, whether that be in Europe or other emerging regions. Obviously, emerging regions are really getting hit here in tangency. Some of that because that oil is really moving in that direction, but also in a risk-off environment, you tend to see the U.S. dollar rally. You tend to see treasuries rally, et cetera. But we think that that's probably more short-lived. So in the short term, we actually do think that there is opportunity here and can be constructive.
Any concerns with Europe with the natural gas issue? Because I believe a large percentage of that natural gas ends up going to Europe.
It does. And when we talk about that inflation impact that you mentioned, there's far more influence on Europe, on Japan, on China, obviously from a headline or an energy-led inflation than there would be in the US. And so that does influence potential, ECB, other central bank policies as they look at balancing employment and inflation. And so today we certainly see that in the price action, and we've seen that evolve over the day. Nonetheless, though, we think it's probably more transitory than it is permanent, and it creates potential opportunity here in the short term.
And we just saw some of the European markets there, and they were all big sell-offs today, far bigger than what we're seeing in the U.S. and Canada.
Yeah, and that makes perfect sense, right? Not just from a literally a geographic perspective and tangency, but where many of those products being produced in the region are flowing through to. Again, the amount of oil, about 85% of it makes its way into Asia. Countries like Japan, they are effectively solely reliant on the import of energy. They have no domestic production. And relative to, say, the United States, not only is a lot of that product not coming here, but the U.S. is a net exporter of energy and oil in particular. So you'll definitely see that market rotation as we see this kind of level of volatility. But ultimately, again, we think it's more transitory than it is permanent.
Okay, we have to wrap it up there. But Brad, thank you very much for joining us. Brad Long is the CIO of WealthSpire. Well, several airlines are suspending more flights to destinations across the Middle East as the scope of the war expands. We'll discuss the implications of that after the break. More than 12,000 flights have been canceled across the Middle East due to disruptions caused by the war between the U.S., Israel, and Iran. Here to talk more about the impact on the aviation sector is John Graddick, lecturer and coordinator of aviation management at McGill University. John, thanks as always for joining us.
My pleasure.
This is not just the Middle East, is it? This is going to affect airlines around the world now and probably for a little while to come too, won't it?
Yeah, it's disruption started on Saturday, and we've had close to 12,000 cancellations. We've had many multiples of that in terms of delays. Airspace is intermittent. Airspace is closed over some of these countries. Airspace is limited in some of these other countries. This area of the world has evolved over the last decade as what I would call a mega hub for aviation globally. The carriers operating into Doha, into Abu Dhabi, and Dubai have really built this infrastructure and this fleet, basically move as much traffic as they possibly can through those hubs from around the world. So they move somewhere in the range of about 500,000 passengers a day through those three hubs. So this is a very, very significant impact on global aviation.
And then I guess the value of do we know what the value of the freight that goes through that region?
I think that in terms of tonnage, it's difficult to ascertain because that's not in the public domain. But you would say that, they have freighters, they have hundreds of freighters that transit through those three airports. They've built up cargo infrastructures to handle connections and transit freight. So there's tens of millions of dollars a day going through those airports.
I mean, I guess first question, with everything that's gone, 12,000 flights canceled, these people obviously are trapped there. How are they, is there any way to get them to where they were supposed to go? I mean, mostly I imagine to get home for a lot of them, but are they moving on the ground or are they just sitting still right now?
Well, remember what these carriers have been doing. When you fly on Qatar, if you fly on Emirates or Etihad, they basically fly long haul into those three cities and long haul out. So the people that are stranded are not necessarily in Doha or Abu Dhabi or in Dubai. They're stranded. I had calls this morning from Kenya, calls from Sri Lanka, calls from Singapore saying my flights have been canceled through Doha or through Abu Dhabi. What do I do? And so this is like I said, it's a global issue. It is not just concentrated on traffic to or from these Gulf areas. It's really a lot of global traffic going through it. So if you're flying from Toronto to Hyderabad or into New Delhi, the odds are you're going to be flying through the Middle East. So those flights are canceled or reduced significantly. So it is affecting global traffic, especially those connecting passengers.
And I imagine, I mean, for the flights from elsewhere that aren't even going into that region but are going around it, they are now flying, can they fly around this massive region that's essentially a no-go zone?
Yeah, it is. And that's airplanes can go anywhere that they get authorized to go. The question is getting authorization to fly around it. So they've got, there's a lot of airspace in that area of the world that is currently restricted. You have Russia, of course. You have the Ukraine. Now have the Middle East. 12 countries have got airspace restrictions. So you got a very narrow corridor for moving a lot of these airplanes. So those, if you look at flight tracking software that talks about the congestion, those corridors are heavily congested, and you need authority from the air traffic control operation and from the country that you're flying over. And there's a backlog, and that's why you have delays. So it is a very congested, run around this war zone.
And I imagine from a mechanical point of view, too, the longer these planes are on the ground, they don't like sitting, do they? And it's very expensive to keep them sitting.
Yeah, I think that, you've got about 35 airplanes from the Middle East carriers that are currently stuck in North America. So these airplanes have been stuck now for at least a day, if not 3 days. So those airplanes will need some tender loving care to get them back in the air. Crews are not, the crews are not readily available. So while you have a lot of airplanes, that are on the ground in the Emirates or in Qatar, there's a lot of airplanes that are stuck that have no crew, no mechanical support until you decide to basically bring them back into service. And there is going to be a significant amount of work required.
I can imagine. Now, how long can this go before this? I mean, this is already a big problem, but how long would it take to try and get back to normal? Say this lasts another month, which is possibly what's been hinted at. How long might it take after that to get everything flowing back to normal, if it's even possible?
Well, it's possible. I think it is possible. The question is going to be one of looking at the extent of disruption and how the airlines basically decide to bring everything back into play. Usually, this is like a snowstorm, 72 hours to get everything back to play and make sure the crews and the airplanes are. So restarting it is not going to be an issue. This one, because the airplanes are stuck around the world, it'll probably take a week or so once we've given the all clear that it is safe to operate through that territory. So a week to get everything back into play. The problem is going to be how long does this last, and what's the impact going to be on the price of oil and price of fuel? As a previous guest mentioned, this hopefully is a short-term blip, 10, 15 days. If it goes on beyond that, and we now go into significant increases in the price of oil, this could put a couple of carriers in deep trouble financially. Those carriers that are marginal at this point in time, that have cash flow issues, that have some traffic issues, those are the ones we have to keep an eye on to make sure that there is a risk associated with those carriers that are the marginal carriers.
Okay, John, we have to wrap it up there, but thank you as always for joining us.
My pleasure. Have a great day. Take care.
Cheers, John. You too. John Graddick, lecturer and coordinator of aviation management at McGill University. Coming up, we will speak with the CEO of PMET Resources to discuss how the company's lithium project is presenting a significant opportunity for several critical minerals. More in a moment. Let's head back to the conference floor at the PDAC Mineral Exploration and Mining Convention, where Andy Bell spoke with the CEO of PMET Resources, Ken Brinsden.
A lot of buzz about lithium. There's a lot of buzz about rare earths. BNN Bloomberg's here at PDAC, the world's #1 mining show. Our guest says he's got a deposit in northern Quebec that could supply both. We are joined by Ken Brinsden. He's the CEO of PMET. Thank you very much for joining us, Ken.
Oh, my pleasure, Andy. Nice to be with you.
Tell us about your deposit in Quebec.
Our Shakajuanan project is a remarkable discovery. Per your intro, a confluence of scale and grade in lithium, cesium and tantalum. It really is a rare find, and we're very pleased to be able to continue to progress our project down the development pipeline.
And you yourself, we can tell from the accent, you've got an Aussie connection. You've worked on lithium mining, hard rock mining of lithium in Australia.
Yeah, absolutely, Andy. My former company, Pilbara Minerals, now PLS, and a very large player in the hard rock lithium industry. And the connection comes about because in my period of time working at Pilbara Minerals, we started to get exposed to the early stages of the discovery at our Shakajuanan project. And it was remarkable. So I couldn't help but follow it, Andy. I'm pleased to be involved.
So the Australian company had a stake in PMET, or how did that work?
Well, not at that time.
Okay.
But a general interest in what was happening in the lithium world, including in Quebec and in Canada more broadly. So that's where the original interest came from.
So your project is not that remote. You've got lots of Hydro-Quebec infrastructure, for example. What kind of capex, roughly, do you think you're looking at here?
In our feasibility study of late last year, we announced the first round of capex being approximately 950 million Canadian dollars. But it's a big lithium mine. In the lithium world, if you're producing, like in our stage 1, 400,000 tonnes per annum, in stage 2, 800,000 tonnes per annum, you would readily be in the top 5 producers globally. So,
including the brine or hard rock?
With reference to the hard rock world.
Okay.
Perhaps the bit that's a little bit unique about the Shakajuanan project is the co-product opportunity, which we believe will ultimately be an important part of our product offering. You mentioned the rare earths and the critical minerals world. Well, at Shakajuanan, we've got all 3 on display. 3 critical minerals: lithium, cesium, and tantalum. And we think that's an important part of the value proposition in the development opportunity at our project.
What is cesium used for? I know it plays a role sometimes in atomic clocks for people who like to be punctual, but what else is it used for?
Of course, yeah. Well, cesium's a really important critical mineral, the first part of which is in industrial applications. The oil and gas industry, the catalysts industry, and a little bit about the pharmaceuticals industry. And yes, high value products that make their way into things like solar, GPS, medical imaging. And in the end, our discovery is enormous. It's breaking the record books. So far, 2.4 million tonnes of pollucite mineralisation, pollucite hosting the cesium. That's a big one. In fact, unparalleled globally.
And then tantalum, what's that used for? Can you remind us?
Of course, tantalum is a really important part of the electronics industry. It's a very important tool for the purpose of capacitance. And how's that linked to today's world? Well, things like mobile devices, data centres would be good examples. So demand for tantalum, especially in the last 12 or 18 months, has been starting to pick up. Pricing's been appreciating. It's also another important co-product at Shakajuanan.
How far away are you from building a mine? When would you hope to actually be in production?
Whilst the discovery was only late 2021, we're now 3.5 years into the mine authorisation process. And our assumption is we've got approximately 18 months to 2 years to go. What does that mean? Well, we should be receiving our mine authorisation in the latter part of next year, so second half of 2027, at which time we'd be making a decision to commence construction and finalising our financing. So it's not too far away.
What about infrastructure? Well, no, we talked about infrastructure. What about processing? Will you process the lithium on site, or how will that work?
The physical concentrates, the spodumene concentrate, the concentrate that contains cesium, the concentrate that contains tantalum, they're all developed at a site level. From there, the concentrate is transported downstream. Our expectation is that the chemical industry continues to grow, and particularly when you have a very large-scale, long-life asset like that ours represents, it inspires further development in Western supply chains to build out the chemical capacity. We have plenty of conversation going on in that regard.
Obviously governments are anxious to secure supplies of these metals. Have you had any investment from any level of government at this stage?
Well, not directly, but certainly some very constructive conversations going on. Where we have had really important investment is from within the industry itself.
Right.
So from our point of view, important shareholdings, Volkswagen Group, who owns approximately 10% of our shares.
Volkswagen, yep.
Yeah, Volkswagen is a big player in the EV world. And then also Albemarle, who is a player in the lithium industry.
A global player in lithium.
Exactly. So yeah, they're important shareholders.
Albemarle is at 4% or something?
4.5%.
Right,
yeah.
And where is Volkswagen in terms of?
9.9%.
Right, yeah. And of course they're working on a giant battery factory in Canada.
Exactly.
Yeah.
So we feel that we will be an important part of their future supply chain.
Ken, thanks very much indeed.
My pleasure, Andy. Thank you.
Ken Brinsden is the CEO of PMET Resources. It's commodities at PDAC, the world's #1 mining show.
All right, thank you for that, Andy. Coming up, we're not done down there yet. Andy will speak with the CEO of FPX Nickel about the company's renowned Baptiste project, which is considered the world's first and most advanced aurorite nickel deposit. Back in a moment. The price of aluminum is rising after Qatar's state-owned energy producer said it would halt output of the metal. The announcement comes as the Iran war continues to impact supply lines for metals throughout the Middle East. Iranian attacks have forced the shutdown of Qatar Energy's major LNG plant. Traders are bracing for widespread disruptions to supplies as the U.S. says there's no fixed timeline for its military action. Saudi Arabian oil giant Aramco is seeking to reroute crude away from the Strait of Hormuz as the route remains closed due to the escalating war in the Middle East. According to reports, the world's biggest oil exporter is exploring the option of delivering more cargoes to the ports in the Red Sea. The move is aimed at avoiding production cuts, the reports come after Aramco was forced to shut its biggest refinery following a drone strike. Shares of Best Buy are climbing. They're up nearly 7%. The electronics store chain topping profit estimates in its latest quarter, driven by higher sales for certain products. The retailer saw continued strength in computers and mobile phones and new categories like AI glasses, 3D printers, and gaming handhelds also seeing strong growth. Best Buy also boosted its quarterly dividends. And a look at the markets. How are we doing? The TSX improving again slightly. It's up down 2.16%, but it was down more than 3.4% in morning trading. So rough day all around. The U.S. market's not much better, but again, bouncing back slightly. They're now down, but they're all down less than 1%. All right. Andrew Bell's been on the conference floor of the PDAC Mineral Exploration and Mining Convention for the last couple of days, and now he's standing by with the CEO of FPX Nickel. Andy.
Hey, thanks a lot. Martin Turenne joins us now. He is the boss of FPX Nickel, which wants to mine a highly unusual nickel deposit in BC. Martin, thanks very much for joining us.
Thanks, Andrew. Appreciate it.
I think we can, you're sort of in the middle of BC there. Could you point it out to us there?
Sure. The Baptiste Nickel project is
Baptiste Nickel. Right. And what's unusual about this one? The mineral has not been mined on a large scale before?
That's right. The target nickel mineral here is called awaroite. Canada's known for sulfide nickel. Yeah. Indonesia's known for laterite nickel. This is a third new novel form of nickel mineral that we believe is far easier to extract and produces a much cleaner, higher grade concentrate product than is typical for Canada.
And it's easier because it's hosted within magnetic rock, or there's a lot of iron there, so you can use magnets?
The mineral itself, awaroite, is highly magnetic. It's an order of magnitude more magnetic than magnetite, which allows us to use magnetic separation to recover the mineral from the non-magnetic rock in which it lives. And that makes a much cleaner process, far less chemical intensive. There's also no sulfur or acid associated with the deposit, which also has environmental benefits from a waste and tailings standpoint.
You're still at a fairly early stage. You haven't done a feasibility study yet.
We've done a preliminary feasibility study, and we're now in the early stages of working on a feasibility, which we expect to complete in the next couple of years. We've also just entered the environmental assessment process, so that has both a provincial and a federal dimension. So we kicked that off in early January.
What's the capital costs roughly of the project, do you think?
Yeah, preliminary feasibility study estimated capital costs of $2.2 billion US. So this is a large-scale project. But with that comes average annual EBITDA in the range of $500 million US per year over a 30-year mine life. So think of it as a big sort of almost porphyry style project, if you want to look at analogies in the copper space.
Is it underground or open pit?
It'll be an open pit deposit. The deposit outcrops in several areas. It'll be a large bulk tonnage operation with a very low strip ratio, well below 1-to-1.
And you have attracted some big investors, including Sumitomo Metals.
That's right. So Sumitomo Metal Mining is a 9.9% shareholder. They're Japan's largest mining company and also one of the largest nickel producers in the world. We also have Outokumpu, which is a Finnish company. They are Europe's largest stainless steel company. Both of those companies have obtained certain offtake rights associated with eventual production from the project. We have a third corporate investor, but it's a bit of a mystery investor in that they wish to remain confidential at this time.
I see. Yeah. So how would you get the concentrate out? You would ship it out, but how would you get it to the coast?
Yeah, the advantage here is that we're producing a 60% nickel concentrate.
Right.
Typical sulfide nickel concentrates are only about 10 to 12% nickel. So this is 5 to 6 times, the nickel content. So our plan is to ship the product by truck to Prince George, put it on rail to get it out to the port of Prince Rupert on the west coast of Canada, which then gives us great access likely to end markets in Japan, Korea, but then also potentially down into the United States as well.
But Finland wants it.
That's right.
Where are their stainless steel plants?
So they do have stainless steel plants in southeastern United States and in Europe as well. And again, given the high grade nature of the concentrate, the shipping costs to get to Europe are not prohibitive.
So they bring it round by the Panama Canal or something?
They could, or we could go eastward on rail as well out to St. Lawrence.
Oh, I see. Yeah, then ship it over the Atlantic. Yeah.
That's
right. So you are on Indigenous land there, and you think you could be dealing with up to 8 Indigenous communities?
That's right. So as part of the initial project description, which we've just submitted to kick off the EA process, we've done pre-engagement over a number of years with up to 8 First Nations that we in the provincial government have identified as being potentially impacted. So during this IPD period, this comment period that we're in right now, it provides nations the ability to put their hands up and to say, we want to be participating Indigenous nations in the process. Again, we believe there will be up to 8 of those nations involved, and we're very happy to be able to work with them in genuine partnership to advance the project.
Why are there so many Indigenous nations involved if it's just one piece of land?
Yeah, so you have the concept in BC of overlapping traditional territories among nations, between neighboring nations. This is something this is navigated very commonly. That is the case for the Mount Milligan mine, which is the closest mine to us. It's about 80 kilometers away.
Yeah.
Also the Blackwater gold mine, BC's largest, newest gold mine. Similar situation there where you have multiple nations at play. It's something that our team members are very comfortable with.
Now, you're a financial guy, you're a CPA. How did you come to be heading up a nickel company?
Yeah, so I worked with KPMG in the early part of my career, and then with a large chemical company, a Canadian company, Methanex. Came into the mining industry as a consultant, really knew nothing about the sector, but it is, and I think you probably would find this from most people walking the floor here, it's an addictive industry. The volatility scares some off, but it represents, I think, huge opportunity for people who can bear that risk.
Right, and so you were consulting for FPX Nickel? I
was consulting, and then I became the chief financial officer, and I've been the CEO now for the last 10 years.
What do you think? $6 billion, what was the capital cost?
Just over $2 billion.
I'm sorry, $2 billion. I was thinking of KSM, the Seabridge Gold Project there, sorry. $2 billion US. So it's a fair amount of money. Do you have, it's early days, but some kind of equity you'll need to raise, I guess?
We're very clear. We believe ultimately this project, when it comes to fruition, will sit in the hands of a major mining company, likely with a minority partner, likely to be potentially from Japan or Korea, countries that are quite accustomed to wanting minority stakes in projects to get offtake rights. They can bring project finance to the table, and then you would have an established mine operator who's accustomed to operating large open pit projects in Canada.
So ultimately, you don't think you'll be the operator?
No, I think it's the classic junior mining story. We've discovered it, we're advancing it, developing it, but I think when we get to an M&A cycle for nickel assets, we're realistic about what our role is at that point.
Martin, thank you very much indeed.
Thanks, Andrew.
Martin Turenne is CEO of FPX Nickel. It's live from PDAC, BNN Bloomberg. Back to you.
All right, thank you very much for that, Andy. Coming up, we're talking to Mark Dixon, CEO of International Workplace Group. That's after the break. International Workplace Group, the world's largest platform for work with brands that include Spaces and Rigas continues its expansion in the Canadian market as trends toward localized work rise. Here to discuss its recent earnings report and developments in Canada is Mark Dixon, CEO of International Workplace Group. Mark, thanks very much for joining us. Let's talk about some of the numbers for you. Quick, you announced lower annual profit, but you saw revenue growth. What happened there?
Basically, significant revenue growth in terms of the overall system revenue. Revenue growth also at the operating level. With earnings, there's a changeover from US GAAP to IFRS 16 to US GAAP. And what caused the main difference in the earnings was the bond that we took out in 24 not being repeated in 25. So, but the underlying numbers good. If you look down to EPS, that's up significantly, and cash is above expectations and so on. So overall, a good print.
Oh, you just cut out. If you could just repeat that last line there, you cut out there. Oh.
And the really numbers that count for us are cash flow. We're also using that cash flow to do significant buybacks.
Yeah, and 100 million. I'm just looking at the quick numbers here. 100 million in buybacks.
Yeah, we were 50, and we doubled it this morning to 100. And we do this sort of a half year at a time. So we'll then look forward and decide what we do in the second half.
And why go that route? Why double it, and why go with the buyback?
Well, we have a lot of cash flow, and the shares are particularly cheap. So this is the best investment we can make is an investment in our own shares.
And just looking forward before we get into some other things, I want to talk about your outlook. Your adjusted EBITDA is you're looking at 10 to 18% increase over last year. It's ambitious.
That's right. Yeah. So look, overall, we've set out a program to move the company to $1 billion in EBITDA in the medium term. That's 2030. That has significant drop through into cash flow. We are very much aligned to that program and delivering to that program. So the 26 year is important. We've started very well. We've got good momentum at the end of last year and coming into this year. So we're very much delivering as per expectations or slightly ahead of them.
All right. I want to talk a little bit too about workplace trends. You're saying you're opening up more centers in local communities. When you say a local community, how local is that, and what kind of demand is there for it?
Well, look, the workplace has changed, and the workplaces of the past tended to be in large cities, tended to be centralized. The technology has completely changed that. So that basically people can work from just about anywhere and do so. So we are opening centers. We are still opening in the major cities in Canada, but we're also doing the suburbs, and we're also doing smaller communities throughout the country. If you look at where we are today in Canada, we're about 160 buildings. We'd expect to get Canada to be around about 1,500 buildings at full rollout. So we're still only 10% of the way through the rollout. So in the future, Canadian companies and individuals will work much more on a platform, a connected platform, than from an individual building. That is what technology allows, and that is what's happening.
But we're also seeing a lot of companies bringing people back to work. How are you dealing with that, or what kind of impact is that having on the people who are using you?
When you say they're bringing them back to work, and this is there's a lot of sort of loose talk when I say back to work. Look, Canadian workers are working wherever they are. We have two businesses, in fact. One is a business that supports people working from home. That business is growing in Canada. And we have another business that is supplying offices and many other products to those people that want to work from an office. So we're in both businesses, and we're seeing significant growth in both of those businesses. What's happening is, this sort of idea of returning to an office is really sort of quite outdated. It's, by that, what people are talking about is an office that's in a city location, a central location. In reality, what's happening is people are coming back to and working in offices in convenient locations wherever they may be in the country.
Okay.
And the drivers are, if I may just finish on this, much lower cost. Companies want to be capital light in their activities. They don't want to be heavy. They want flexibility. And they want something that's attractive to workers. We deliver on all of those things. So it's very popular with finance directors, very popular with HR directors that are looking to both lower cost and improve on productivity in the workplace.
Okay, we have to leave it there, Mark, but thank you very much for joining us. We appreciate it.
That's a pleasure. Thank you very much.
Mark Dixon is the CEO of International Workplace Group. Still ahead, today's Market Movers with Bloomberg's Matthew Griffin. All right, for some movers south of the border, we're joined by Bloomberg Equities reporter Matthew Griffin. Matthew, thank you, as always, for joining us. It's been a wild day. It opened crazy, but it's not a bounce back, but it's down, but not down what it was this morning. And I'll leave it to you to go from there. United Airlines, where you want to start. It was down, but now has it turned around?
Yes, well, Roger, thank you for having me. And yes, United and other U.S. travel stocks finally catching a breather after a few just brutal days. You had airline stocks down the most since April on Friday as traders kind of tried to position ahead of a possible conflict, extending those losses yesterday. But now shares of companies like United Airlines finally flipped positive just in the last few minutes here, up a little under 0.5%. That loss for that stock still about 11% over the last three sessions. So they're nowhere close to reversing the damage that's been done. But it seems like traders have decided that stocks have decided that stocks like these are pricing in enough pain as they really try to make sense of the situation in the Middle East and as the pain from the conflict really spreads to broader markets today. Although, yes, a bit of a rebound there as well.
All right. And we're seeing it with a lot of travel. The cruise lines, are they still taking a hit today?
Last time I looked, they were in the red, but a lot less than this morning. Those stocks also had fallen Friday and yesterday. Had some a disappointing report from Norwegian Cruise that also contributed. And if you think about why, these stocks rely on fuel. Oil goes up, that becomes more expensive. Also, consumers will want to travel less if there's intense geopolitical conflict or any hit to the economy. So that's really weighed on these stocks. But again, traders were positioning for this. They seem to like where the stocks trade for now. I would say, though, we're not out of the woods yet. Right. The war now entering its fourth day. Okay,
and as my hoity-toity friends like to say, Target had an upbeat forecast.
Yes, Target shares up about 7.5% after the company forecast adjusted earnings per share this year of $7.50 to $8.50. Midpoint there is more than what Wall Street was looking for. This is a sign that a rebound is taking hold at Target. They had a 3-year sales slump with some stock turbulence to match. Consumers have been cutting back on discretionary purchases. They've also been dealing with tariffs. But now investors seem to think that their new CEO, Michael Fidelky, just took over last month, is turning things around. The company also sees a small increase in comparable sales this year. Categories like video games are holding up well. And now, after falling about 25% last year, the stock up about 25% this year.
Okay, and we got about 25 seconds. Caterpillar declining.
Yes, Caterpillar, really interesting example, I think, of broader markets pricing Iran impacts. So not directly linked, but if you get a hit to the economy, spike in inflation, that makes, for example, construction less appealing, and that's hitting shares of this kind of industrial company today. Also consumer discretionary, that kind of thing, taking a hit on the broader impact.
All right, we got to wrap it up there, but Matthew, thank you as always. Bloomberg's Matthew Griffin. And that wraps up this edition of Trading Day. I'm Roger Peterson. Thank you very much for joining us. Have a great afternoon.